Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. Okay, so the next topic that we need to address relates to consolidated corporations. So we're talking about the filing of a tax return for these consolidated corporations. So in the United States, corporations will have the opportunity to elect to file a consolidated tax return. So basically we're saying here, if Shark Corp owns 3 subsidiaries, Minnow Corp, Dolphin Corp, and Whale Corp, they could potentially consolidate the tax return into one single return. All right, but there are specific rules for corporations to qualify for this consolidated tax return filing status. Okay, so we're going to break out the primary topics that are associated with this concept, and more importantly, some of the different areas that you should be familiar with come exam day. Okay, so at the end of the day, this topic isn't necessarily make or break, but it is something that you should be familiar with if you do see this pop up in a multiple choice testlet or a task-based simulation. All right, so we need to be ready for anything they throw your way. So we're going to talk about the following 4 areas. We're going to define an affiliated group. We're going to talk about the advantages and disadvantages of consolidated corporate tax returns and some additional consent forms that need to be filed. So let's start by defining an affiliated group. This one is important. At the end of the day, when consolidating financial statements, we need one corporation to be a member of an affiliated group. So all that is saying is one corporation must own at least 80%. And 80% of what specifically? 80% of another company and 80% of the voting right for the company. Okay, so in this case, that's going to be Shark Corp. They must own at least 80% of those 3 subsidiaries. So at the end of the day, it could be 2 companies, it could be 10 companies, it could be thousands of companies under the parent company's umbrella. Right, but bottom line is there needs to be one company that owns at least 80%. So when you're thinking about the word parent company, you're thinking this is associated with the 80% test, right? For financial reporting purposes, the consolidated requirement would be 50%, but we're talking about tax purposes. For tax purposes, the percentage threshold is 80%. Okay, and we're going to think of that as being synonymous with affiliated groups. Okay, so breaking out a few of these examples, Shark Corp owns 80% of Whale Corp. Okay, so these are going to qualify for consolidation. Okay, so these can file the same tax return as one consolidated entity. Okay, but it's not always going to be that straightforward. Let's say now that Shark Corp owns 80% of Whale Corp. All right, while Whale Corp owns 60% of Minnow Corp. So which of these 3 entities are going to qualify for consolidated filing status? Okay, so Shark Corp is going to qualify because they own 80% of Whale Corp. So Whale Corp is still going to qualify and fall within this consolidated tax return. All right, but because Shark Corp doesn't directly own Minnow Corp and Whale Corp only owns 60% of Minnow Corp, they're not going to meet the 80% threshold. Okay, so Minnow Corp would actually not qualify for consolidation. But now let's say instead that Shark Corp owns 80% of Whale Corp and 30% of Minnow Corp. Okay, so Shark Corp also now owns directly 30% of Minnow Corp. Okay, so Whale Corp still owns 60% of Minnow Corp. So in this situation, all 3 of these companies will qualify. Okay, let's break it down. Shark Corp owns 80% of Whale Corp. So Whale Corp is going to qualify. We already know that. It comes down to qualifying Minnow Corp. So because Shark Corp owns 30% of Minnow Corp and Whale Corp owns 60%, we can add these 2 percentages together, which will make an affiliated group. Okay, so this now exceeds the 80% threshold. Okay, so got to be on the lookout for the parent company's direct investment and ownership in each of these subsidiaries. All right, it is going to impact whether or not it qualifies. All right, and something sneaky to note is there is a slight exception to this rule, and that is when two corporations are owned by 5 or fewer individuals, estates, or trusts. This would result in what's referred to as brother-sister controlled groups. Okay, so not overly important, but a term that we should be familiar with. Okay, so now let's talk about some of the different advantages and disadvantages in filing a consolidated tax return. Okay, so the 4 primary advantages that you should be familiar with is that losses of one corporation can offset the taxable income of another corporation. It's going to be easier to avoid certain limitations if we're filing a consolidated tax return. Gains on certain intercompany transactions are not going to be recognized in the current period, and taxation of intercompany dividends are always going to be eliminated. Okay, so let's break this out. Okay, so first advantage is losses offset income. So let's say that Whale Corp owns at least 80% of Dolphin Corp, right? This is an affiliated group. And Whale Corp has $10 million in operating income, whereas Dolphin Corp has $10 million in operating losses. The losses from this subsidiary can offset income from the parent company. Okay, so the $10 million in operating losses are going to offset the $10 million in operating income. That's a win for Whale Corp. Right now, all of a sudden, Whale Corp isn't paying tax on the $10 million of operating income. All right, one of the next great advantages for consolidated filing is the bypass of certain limitations. So what do I mean by that? Great example is the charitable contribution deduction limitation. Right, for corporations, it can be a certain percentage. In this case, it's going to be 10%, right? We remember that corporations can contribute to charity and take a deduction, but only up to 10% of their adjusted taxable income. Right, let's say that Whale Corp now has $10 million in income and Dolphin Corp has $5 million in income. Let's say that Whale Corp contributed $2 million to a charity. Now, if these companies were not consolidated, then Whale Corp could only take a deduction up to 10% of the $10 million, right? They would only be able to deduct $1 million of this $2 million. But because they are consolidating, they can now take both of these income amounts and make this their adjusted taxable income that the deduction will be limited to. Okay, so instead of being limited to $10 million, it can now be limited to $15 million, the $10 million from Whale Corp and the $5 million from its subsidiary Dolphin Corp. All right, so the charitable deduction is now limited to 10% of 15 million, which would be 1.5 million instead of 10 million, right? They're now going to be able to deduct an additional $500,000. Okay, so next, gains on certain intercompany transactions are not going to be recognized. What do we mean by that? Well, they're not going to be recognized in the current period. So we can essentially defer a gain from an intercompany transaction. So this is one related party, which in this case would be Whale Corp, selling their property, plant, equipment to Dolphin Corp. And let's say that the property's basis was $1 million and they sold it for $1.2 million to Dolphin Corp. Okay, so the gain from the sale is not going to be recognized today. It's going to be recognized when they later sell it to a third party. Okay, so if Dolphin Corp subsequently sells this property to Tiger Corp for $1.5 million, it is not until this transaction is made that tax would be recognized. Okay, so in the consolidated financial statements, the entire gain is now going to get recognized. All right, so the consolidated financial statements will report a taxable gain of $500,000, the $1.5 million over the $1 million basis, right? It's almost as if this $1.2 million transaction never happened. Okay, at least not for tax purposes. The next one is going to be taxation of intercompany dividends. These are going to be eliminated. What do we mean by eliminated? Meaning they're not going to be taxed. All right, and why would that make sense? Because otherwise it would be double taxed, right? If Whale Corp paid a dividend to Dolphin Corp in the amount of $300,000, Whale Corp's already paying tax on that income. All right, so if they give it to somebody else within their consolidated financial statements, they're not going to have to pay tax again. So this $300,000 dividend received by Dolphin Corp is going to get eliminated. It's not going to get recognized. Okay, so those were our advantages. How about some of the disadvantages to filing consolidated tax returns? So the first disadvantage would be once we have elected to file a consolidated tax return, we have to file it again for all future years. Right? This isn't something that we can decide one day. We're going to file a consolidated tax return for all of our subsidiaries. Right? Maybe it's cheaper to do that. Maybe we don't have to pay our tax practitioner as much money to file our tax return for all of these consolidated financial statements. Okay, so if Shark Corp elects to file a consolidated tax return in year one, then they have to file a consolidated tax return in year 2. And all years going forward for that matter. And they're going to have to do this until the affiliated group changes. Right? So let's say in year 1 they own 80% of Dolphin Corp. Maybe in future years they sell off a portion of Dolphin Corp and they no longer own at least 80%. So it is not considered an affiliated group, meaning now they cannot file a consolidated tax return for that entity. All right, but they can't just do it because they want to. All right, and ultimately that is the disadvantage. Next disadvantage, corporations within the group must use the same tax year as the parent corporation. All right, so if Shark Corp is using a December 31st year end, then all corporations within Shark Corp's consolidated financial statements must also use a December 31st year end. Okay, so why would that be a disadvantage? Well, what if they acquired over 80% sometime during the tax year? Right, let's say they acquired it in May. Then it might not be entirely reflective for tax reporting purposes. All right, next disadvantage, losses from intercompany transactions are not deductible until sold to a third party. Right, we talked about gains not being recognized until sold to a third party. Right, we're deferring gain recognition, which could be a good thing. But this also means that we can't deduct our losses until that property is sold to a third party. Okay, deferring gains is a good thing. Deferring losses, not so much. All right, so same example. Whale Corp is going to sell off their property with $1 million basis to Dolphin Corp, only now they're going to do it for $700,000. Okay, so now the loss from the intercompany sale is deferred. If Dolphin Corp sells this to Tiger Corp, it is now that the loss would be deductible. All right, so not going to be deductible until a third-party sale. Okay, and the next disadvantage, cost of compliance with specific regulations. All right, so it's going to cost money to comply with the regulations for tax reporting purposes for consolidated corporations. Right, filing these tax returns requires specific tax treatment. This could get a little bit complicated. And in order to comply with those regulations, it can be a little bit more costly. All right, so those are the primary advantages and disadvantages for consolidated tax reporting companies. Okay, so when filing consolidated tax returns, they're still going to file Form 1120. Okay, so that is the same form that a C corporation would file when reporting their normal tax return. All right, but they're still going to file Form 1120 when combining the results of all consolidated entities. Okay, and as we remember from our disadvantages, once they elect to file for consolidated tax reporting status, they have to continue to use consolidated tax reporting for future years. Right? They can't just flip-flop and all of a sudden no longer report this in a consolidated way. Okay, so it's not only going to be Form 1120. There's also Consent Form 1122 that must be signed by each member of the affiliated group before the tax year is over. Okay, so this is a form that is simply going to be attached to the election for consolidation by the extended due date of the parent company's tax year. All right, that's the consent form to say, yes, we want this to be reported as a consolidated entity. Okay, each year thereafter, they have to file Form 851. That's going to break out each member of the consolidated group. Okay, but not every single type of company can be considered an affiliated group, right? In fact, most companies are going to be excluded from this qualification. All right, so ineligible corporations will consist of S corporations, will also consist of partnerships and LLCs, right? Most pass-through entities. Okay, it's also going to exclude trusts and estates. It's also going to exclude other tax-exempt reporting entities, such as charities and insurance companies. All right, also going to exclude real estate investment trusts, right, our REITs, and corporations that are not within the United States. Okay, so it has to be a United States reporting company. All right, so at the end of the day, this is basically C corporations only.